Welcome to your regular market and investing program, the DLM Market Hall. As the year rounds up, we take a look today at the bond market and how it has fared for the year 2013. We meet to do this very interesting analysis is Mr. Tola Odukoya, Vice President, Investment Research, Dunnlorrenmerrifield. It's great to have you, Mr. Tola.
Thank you.
It's been a great year.
Well,
in markets.
yes.
Yeah.
Yes.
And now when we look at the bond market, in terms of overall performance, how would you assess it?
Well, it's been a good year, although certain things we would have loved to see with respect to the interest rate environment didn't occur. However, it's been a good year to the extent that, for example, in Q1, the inclusion of federal government bonds in the Barclays Bank Emerging Markets Index came on stream, and which further boosted the confidence of international investors in the domestic bond market with respect to federal government bonds. We've also seen a kind of resuscitation of the non-sovereign bond market, the issuance of non-sovereign bonds, particularly state bonds. And we've also had a couple of corporates come to the market to raise money via the bond market during the year. Yes, also we've seen increased activities, particularly as a result of inflow of portfolio funds from investors. So to that extent, you may want to say that yes, it's been a good year. However, the fact that interest rates are still quite high within the economy still remains a major source of concern to us, given our preference for low interest rate environment and our gospel of the need to stimulate growth within the domestic economy by reducing interest rates.
While you were discussing, looking at the year, you talked about the emerging markets, that's FGN bonds inclusive into the Barclays, and that is giving us a good scope for investment, especially international investment. How do you assess the domestic and of course foreign investments for the year in the bond market?
Well, we've seen really the international investors being the bellwether investors for the bond market in Nigeria. Essentially, because if you remember last year, before the inclusion, the JP Morgan inclusion of the Nigerian federal government bonds in their index, it started with JP Morgan before Barclays also did the same thing. The bond market was a bit lukewarm. Prices were low, yields were a lot higher, until JP Morgan included Nigerian federal government bonds in their index. And what that means is that once institutions like JP Morgan, or in the next instance Barclays, include a country in their emerging bond indices, what it means is that portfolio managers across the world who follow that index will now include that particular security of that sovereign in their respective portfolios. Hence, what we've seen over the last 18 months or thereabout, where foreign portfolio managers, by virtue of the inclusion of Nigeria in the JP Morgan index and the Barclays index, now started demanding for Nigerian government bonds. As a result, the increase in demand for those bonds meant prices went higher and yields moderated about 200 to 300 basis points. So that is what it means for the domestic market. We've seen that increase in foreign investors coming into the market, which actually drove activities. We've also seen a lot of increase in participation from pension funds. The banks have been a constant all this while. They are required to trade in bonds anyway to hold such securities on their balance sheets for prudential guideline reasons and so on and so forth. So that's why I said it's been a good year. It's been a good year. However, we would have loved for it to be a better year by virtue of having low interest rates within the economy, where, for example, the kind of resuscitation we've seen over the last 4 months by the increase in issuance of state bonds and a few corporate bonds would probably have a higher level of activity in the non-sovereign market, where people can actually raise long-term capital at sustainable interest rates.
Yeah, now this interest rate comes up again, resonates. So let's look at the interest rate. It has been fixed through the year at 12%. we know that in the BRICS axis, they have a favorable interest rate that drives the economy, like Brazil, Russia, India, China, and South Africa. And that 12%, how has it enabled the bond market? Is it stifling it, or is it going to so much rigors?
Well, it's a two-edged sword. One part of it, the good part of it, is what we've seen, where it's opened up Nigeria to the international investors. However, the not so good part of it is that by opening Nigeria up to such aggressive inflow of portfolio investors means that when those investors decide to leave, you probably will see some kind of shock hitting the financial markets, particularly the bond market, and probably put the domestic currency under pressure also, because if you recall, a bit of stability in the currency has been on the back of the inflow of foreign funds from these portfolio investors across from offshore. So that's the kind of impact you would see in the market. So like I said, the point, I don't think one can ever overemphasize this point, the need for us to have a lower interest rate regime where people can raise funds at sustainable interest rates. Because once interest rates are too high, it's really not sustainable again. But there's hence the need for it to be low so that it can be sustainable, because we're talking of 5, 7, 10-year money being raised here. So we want to see single-digit interest rates. But the other side of it is that we would have loved a lower interest rate environment where you'll be able to stimulate domestic growth. You mentioned the emerging markets, and we are well aware of what's happened in the US and in the UK. But I think it's good to highlight the fact that what you've had in the US, UK, and some parts of Europe in quantitative easing is not what we are advocating. Because in stimulating growth with low interest rates, quantitative easing in economics is actually the last port of call. And what that means is that initially you lower interest rates so that corporations, sub-sovereigns in the case of Nigeria, subnationals, or states are able to access funds at lower rates, long-term funds, exactly, at sustainable rates, which drives growth over the long term. However, quantitative easing now is in the absence of that, where that has failed. Because if you remember, before the US and the UK actually commenced their quantitative easing, they had lowered interest rates. However, that failed to stimulate domestic growth, hence quantitative easing. Now, what quantitative easing does is for the central bank to directly put money into the economy by buying government securities of financial institutions. So, for example, let's assume that in Nigeria you have ₦1 trillion worth of government bonds sitting in banks. If the Central Bank of Nigeria were to do quantitative easing, Central Bank of Nigeria would say, you know what, I will buy 500 billion worth of those bonds off you and give them cash directly so that they can on-lend that cash into the economy at low interest rates. That's not what we're saying. What we're saying here is that let's even start with bringing interest rates down to single-digit levels so that corporates, especially the SMEs, and some states who have projects that could actually drive activity within their respective environments that will bring increase in commercial activity, thereby increasing taxes for those respective states and their IGRs. When they can access such funds at lower interest rates, right, to develop their respective states, you can actually see increase in commercial activity, and as a result of that, expansion in domestic output. That is what we are advocating, which is quite different from quantitative easing.
So what should be done to increase the level of activity for the bond market into 2014, considering how 2013 has fared?
Well, I think one way to look at it would be, I would love to see a reduction in interest rates, in MPR, for example. And that's very simple. That's the only way you would probably see an increased level of activity on the primary side of the bond market. I'm talking about state bonds now, but particularly corporate bonds. I'm particularly a fan of corporates, SMEs, especially being able to access long-term capital at sustainable interest rates. And remember how the federal government bond market also was, kick-started in 2003 with the issuance of the 3-year bond, and then the secondary market came on board in 2006. The point I'm trying to make is that right now the only bonds that are really trading in terms of activities in the secondary market are essentially federal government bonds because of the size. And for you to now include states and corporates in that mix, you probably need to have an increase in activity on the primary side, because remember, issuers have to issue securities for you to trade them. So what I'm simply saying is that once we can have lower interest rate environment, as the market continues to build in size, in volume of issuance and so on and so forth, you also see that activity going on or increasing in the secondary side of the market, i.e. investors being able to buy and sell those bonds. Good thing we now have several platforms where those bonds can be traded now. The NSE recently appointed market makers for bonds. We have the NASD, which was launched a few weeks back. Yes. We also have the other platform, FMDQ now, where you can actually trade those bonds. So those are the kind of things that are already in place. Now, what you now need to have is activity on the primary side for you to now increase activity on the secondary side. And the activity on the primary side will have that increase if you have a lower interest rate environment, thereby encouraging the issuers to be able to come to the market to raise the long-term capital required for them to meet their various business activity needs.
Thank you very much, Mr. Tola Odukoya, for the time. It was a great moment listening to analysis on the bond market for the year 2013 and also the outlook for what we expect in 2014. Thank you very much. So that was the bond market in review for the year 2013, and of course an insight to what 2014 should look like for the bond market. Till the next edition of the favorite market and investing program, the DLM Market Hub, keep a date with it next Tuesday.